Okay, so today's lesson is on the balance sheet. I'm going to share my screen with notes that I've made for the balance sheet. So you should all be able to see my Word document. Okay. So to start off, a balance sheet is basically shows the financial position of a business. Okay. They are shareholders in a company, and those shareholders are basically all the different owners of the company. We don't have one separate owner, it's just a big group of owners. Okay, so when we look at a balance sheet, we're going to have our assets section and our equities and liabilities section. As we know from the accounting equation, assets equals owner's equity plus liabilities. So at the end of our balance sheet, once we've completed it, the number of total assets should equal the number of total equity and liabilities. So with non-current assets, we are split into fixed assets and financial assets. Non-current assets are basically assets that won't be converted into cash within one financial year. Current assets are assets that will be converted to cash or are cash within 1 year. Fixed assets have a note number 3. If we go, this is just a basic idea of what note number 3 looks like. This note is heavily covered in the section of fixed assets. Generally, you'll have columns over here with vehicles, equipment, and land and buildings. So we're going to start off by explaining note 3. So with cost, if we had one column and it was just equipment. Okay, so with the cost at the beginning of the year, that is the amount that we purchased our equipment for at the beginning when we bought it, what the total cost of all our different equipment totals to. Accumulated depreciation is the total depreciation that the equipment has incurred over the time that we've held the equipment for. So basically, it'll be the depreciation for each year that we've had it. The difference in these two, so if you say cost minus accumulated depreciation, you're going to get your carrying value over here. As soon as your accumulated depreciation is going to be the same or more than your cost, you can never have a negative carrying value. So what you do is you make your carrying value 1 rand. And that's like the lowest number it can be. So if our carrying value is 1 rand, then we will have our cost and our accumulated depreciation generally ending in 9999, because generally our costs are rounded figures. Not always, but just generally speaking. Then that's at the beginning of the year. This is stuff that's happened from last year, so that's why these are generally given figures in your notes. Then with movements, you have additions, depreciation, and disposals. Additions is when I buy any more equipment during the year. I will record this at my cost price. So say now I bought additional equipment for 10,000 rand. In additions, I'm going to have 10,000 rand. I'm adding to the value of my cost. Depreciation is the wear and tear of my equipment. So throughout the year, at the beginning of the year, it's not going to be the same value as at the end of the year because I've used my equipment. It's worth less. They will give you a percentage to work out your depreciation. And then disposals. That is when I sell some of my equipment. Generally because It's old or we no longer use it. And disposals are at carrying value. Carrying value is your cost minus your accumulated depreciation. Then your carrying value at the end of the year is going to be your cost at the end of the year less or minus accumulated depreciation. To get these figures, you'll have your cost will basically be this cost plus any additions at cost, and then subtracting your disposals at cost to get your cost amount there. Accumulated depreciation will be this accumulated depreciation plus any other depreciation for the year minus depreciation that was based on the disposal. But an easier way to work it out would be to just do your carrying value at the beginning, add or minus your movements, your total movements, and get a carrying value at the end of the year. And then work backwards to get accumulated depreciation from your cost and from your carrying value. You would say your cost minus your carrying value would give you your accumulated depreciation. Okay, so I'm just going to, so you guys were on mute just so I could explain that. Are there any questions for the fixed assets?
Quick question.
Yes.
With the accumulated depreciation section,
Yes.
you said it was so the first accumulated depreciation at the beginning.
Yes.
Minus the depreciation of the disposed assets.
Yes.
Does this include the whole figure for the asset disposed, right?
So basically it's going to be, so you'll take, say now your accumulated depreciation at the beginning is 100,000 Rand. Okay.
Mm-hmm.
Then you have more depreciation in the year of 20,000. So now we're sitting on 120,000. But part of that 120,000 is depreciation of something I've disposed, something I've sold. So the accumulated depreciation on the item I've sold must be taken out of that amount.
Okay.
So what you would do is you would say, you wouldn't take off your whole disposal amount, you would take off the accumulated depreciation that you have on that disposal.
Okay.
Okay. Any other questions for fixed assets?
Not from my side, no.
It generally is easier to work out carrying value at the end of the year and your cost to then find accumulated depreciation. And a lot of the time they might give you certain figures and then you would have to monkey puzzle to get the rest. So it's not necessarily that you'll need to use that formula. I'm just saying it just in case.
Okay.
Okay, so now I'm going to put you guys back on mute so that I can explain the next section. Okay, then that was fixed assets. Financial assets don't have their own note. It's generally a fixed deposit or some sort of investment that you would have that is not going to mature within 1 year. The reason it doesn't have a note is because there's not much going on. It's just a figure of a financial asset. So that would just be put into there. You would then take these two amounts and total them up into the non-current block. Okay, then with your current assets, they are broken down into 3 categories: inventory, cash and cash equivalents, and trade and other receivables. They also have their own notes. So note 4, note 5, and note 6. So if we go to note 4, we will see that inventory is made up of trading stock and consumables on hand. Trading stock is generally, you'll have a balance from your information. So the balance from at the beginning of the year. Then there'll be 1 or 2 adjustments. say now they forgot to record a sale of some stock, then you would have to decrease trading stock by, and there'll be 1 or 2 adjustments, as well as what's very common is trading stock deficit and trading stock surplus. This amount of trading stock in inventory is going to be the final amount that you have in your stock after stock count and whatever. That final amount is going to be what's going to be recorded in here. Consumables on hand is any consumable stores that you have bought during the year, but you haven't used. It's kind of like the leftover. And since it wasn't used, it can't be recorded as an expense. So we record it in our assets as inventory because we'll use it the next year. It's basically anything that's left over. Okay, so that, and then these two you would total up to get to inventory. Okay. Any questions with inventory?
No.
I have a question with the trading stock deficit. Where would that adjustment be?
So what you would do is you would put it into this in a bracket in trading stock here. So say now you had a trading stock surplus. So you've realized you actually have an extra 150 Rand worth of stock. You would say your balance plus 150 Rand, and then that would give you your total balance. That 150 Rand would also go into your income statement. It would be an income, and it would be called trading stock surplus.
Okay.
Yeah.
Okay, thank you.
No problem. Any other questions?
No.
Okay. Okay, then I'm going to go on to cash and cash equivalents. So with cash and cash equivalents, this is generally the current assets that are already cash. So it's not something that will be converted into cash. We start off with our bank figure. That is just the amount that they give you for balance. And then you just generally will have 1 or 2 adjustments again, increasing or decreasing your bank amount. If you must be careful that they don't give you a bank overdraft. Bank overdraft is a negative bank balance. So it's when you've gone into negative and you actually owe the bank money. It would then not go into cash and cash equivalents. It would go into your trade payables or onto your balance sheet face. It's up to you under current liabilities. As long as it's under current liabilities, you can either put it into trade and other payables or you can keep it separate. And that would be a bank overdraft. The other items are cash float. Cash float is just money you have in your tills so that you can give change to customers. Petty cash, you have, I think you remember from grade 10, there was a petty cash journal. It's basically money that you have in your business just on the side for small, quick payments that you need instead of having to use a bank card. And then a fixed deposit maturing, that is when maturing means that you're going to actually receive cash from it. So a fixed deposit, I take money and I deposit it into a bank as a fixed deposit. I decide on the amount of time it's going to be there for, and say now it's 3 years. If it is now going to be the end of the 3 years within the financial year that I'm recording my balance sheet, I would put that amount into fixed deposit maturing because I'm going to be receiving that cash within a year. So it's no longer going to be part of my financial assets. It will become part of cash and cash equivalents because it's going to become cash. With bank, there will be 1 or 2 adjustments when you are working out your figure. Cash flows and petty cash generally don't have adjustments. And fixed deposit maturing, it's generally just the figure that you're going to be receiving that year. Sometimes the fixed deposit, part of it could be maturing and part of it can be remaining in the fixed deposit. Then you would have to split it into what is going to be maturing and what is staying in my non-current financial asset. Okay, any questions with cash and cash equivalents?
with the fixed deposit, oh, sorry. With the fixed deposit maturing,
Yes.
am I correct in saying that it's current portion of fixed deposit, right?
Yes. So you can say either or.
Okay.
It just, some
Oh,
schools
okay.
just say it differently. So yeah, that's 100%.
Okay, cool.
Yeah. Any other questions?
No.
Yeah. So then, if we move on to trade and other receivables, this is quite a broad note. Generally, we'll have net debtors, and you'll have trade debtors and provision for bad debts, prepaid expenses, and accrued income. There are many other things that can go into here, like SARS, and if SARS owes us money, then this is where it would go. It's kind of, if there's no other place to put an asset, it will generally go into trade and other receivables. Obviously, it has to be receivable within the year to be a current portion, to be in the current part, but generally these are quite flexible in the way that they set up. With trade debtors, sometimes you can also call it debtors control, it's the same thing. That is basically my amount that I have for debtors control. And you basically are going to have an amount in here. Then your provision for bad debts, it's kind of like, it's going along the lines of the prudence concept, because you're trying to be conservative and you're trying to rather prepare for the worst. So you would have a percentage of your debtors, you would calculate. It's generally a small percentage, like 3 to 5%. They would tell you what the percentage is though, and you would work out a percentage of your debtors, and that percentage is your provision for bad debts. It's kind of like, I'm expecting this amount of my debt to actually not be paid to me. But instead of it just being bad debts from the beginning, we kind of prepare for it so that we can be conservative. Provision for bad debts, when you are calculating it, you have to compare it to last year's provision for bad debts. So if we get so say now we have our debtors control amount, we have a percentage of 5% that needs to be adjusted for provision for bad debts. We would work out the 5% of debtors control, and then that 5% would become this new amount here. You would just put in that amount. That is your new provision for bad debts. But the change from last year's provision for bad debts to this year's provision for bad debts, that amount goes into your income statement as your provision for bad debts adjustment. If your provision for bad debts increases, it's a bad thing. It's negative, because now we're thinking, okay, there's going to be even more people that are not going to pay us. So that's going to be an expense. It'll be provision for bad debts under your expenses. If your provision for bad debts decreased, we're saying, okay, that's good. Now we're expecting there to be less people who are not actually going to pay us. So then we would record our provision for bad debts into our incomes in our income statement. Okay, that is basically that for the debtors. Prepaid expense, this is something where the business has decided to pay early for one of their expenses. The most common would be rent expense or water and electricity. And generally you'll have to use a calculation to get your amount. So if they say you've paid for 3 months extra of water and electricity, you would take your water and electricity amount and calculate what amount is extra. So if I've paid for 15 months worth of water and electricity, because it's the year's amount plus 3 months, then I would say that amount divided by 15, because now I want to work out, okay, what is my actual per month amount? So I would take my total for water and electricity that I've paid for 15 months, divided by 15, and times by how many months were extra. which were the 3 months. And I would record that amount in my prepaid expense. That is a more difficult example. Sometimes they do give you the amount that was prepaid, so just the extra amount. But if you have to calculate it, you'll generally say divide by how much I've already paid times by how much was extra. Okay. Then accrued income is when we are owed an income, generally rent income. So if my tenant still has to pay me for the month of March. So if they give you a balance for rent income and it's the rent income for the year, but we haven't yet received March's income, you would take your amount for rent income and divide it by 11 because that's what we've received. We've received 11 months worth of income. And that would be the per month amount. That per month amount would be the same amount for accrued income. So then you would put that amount into your accrued income. Okay, I know this is quite a hectic note. So are there any questions with the trade and other receivables note?
The SARS income tax.
Yes.
Can you please just remind me what does it have to be on the debit side or on the credit side in order for it to go into this note?
So if SARS owes us,
Mm-hmm.
if SARS owes us, then it would go into the trade and other receivables because then it'll be an asset. For SARS to owe us, it would have to be on the debit side. Because if you were to look at a account, SARS, if you treat it as a liability, because generally it's a liability, so we'll have minus plus on our T account. If they are owing us, it would be on the negative side. So then it's on the debit side. So then they owe us. Because that would ultimately represent on an asset T account the positive side. So it is the debit side, yes. Okay, any other questions?
I just have a question with the provision for bad debt adjustment.
Yes.
Is it basically you take the balance and then the difference goes into the income statement, or how does that?
Yes, yes. So the provision, in the balance sheet, the amount would be just your percentage of debtors. Then that compared to last year's, so the difference in that would go into your income statement as the adjustment.
Okay.
Yeah. Any other questions?
No.
No.
Okay, cool. Then we're going to move on to ordinary share capital, which is, if we look at here, we have our shareholders' equity, which is the equity part of our equity and liabilities. Shareholders' equity is broken down into share capital and retained income. So we have note 7 and note 8. So if we go to note 7, it'll generally look something like this. This is the main new part for matric balance sheet section, this and retained income. You'll start off with your authorized shares. That is basically how many shares the business can issue. This will kind of be the first sentence with regards to your ordinary share capital. It's not a big thing. You'll just say, under authorized, it'll just be like 500 shares available, for example, depending on what they give you. It's nothing too hectic. There's no figure. It's just a number of shares. Then with issued, the beginning of the year, this is the amount of shares I had in issued from last year. So basically on the first day, before we do anything, this is how many shares are in issue. Then we go, that is generally at an average amount. So like you'll have beginning, so many shares at 5 Rand per share, for example, or 500 cents per share. Then, so you should have a number of shares the rand per share, and then a figure on the end of how much you basically, that would be the amount, this amount here would be the amount in your information from your old balance sheet. Then with additional shares, again, it will be a number of shares issued at whatever cost, and then the total of that received. With additional shares issued, generally, the business would like to have issued shares at a higher price than what the per share amount was at the beginning of the year, because the whole aim would be to increase the amount that we are issuing our shares for. So most of the time it's at a higher price. They would give you this price, or they would give you this the number of shares and what the total amount received was, and then you'd say total amount received divided by the number of shares to get your per share cost. Now, repurchased is probably the more difficult section in the issue. Now, with repurchased, that's kind of when you are buying back your shares, or share buyback. So you no longer want certain people to have your shares, or they don't want your shares anymore, and you kind of buy them back. So that's a repurchase. Again, you'll have a number of shares repurchased at the price. So the price per share that is recorded here is your average price of your shares at that point. So if my repurchase happens after I've issued shares, so say now I issue shares at a higher price, I'm going to find the total average price. So I'm going to say my balance at the beginning plus the total amount of the additional. I'm going to add those together. Then I'm going to divide it by the number of shares in total. So the beginning amount plus the additional. That will give me my average price of what I'm currently sitting at averagely per share. That amount will be recorded here at that cost. Then you would have a total amount here. But generally, well, almost all the time, the price that it's actually repurchased for, the price per share it's repurchased for, is generally not the average. A lot of the time, we repurchase it for an amount that is higher than my average amount, because time has passed, so it's probably worth more. So say now I have now repurchased at 7 Rand per share, but my average is 5.7 Rand, so 5 Rand and 70 cents per share. The difference in that, the 1 Rand and 30 cents per share, that is going to go into my retained income in this repurchase here. That is going to decrease my retained income because I'm paying more than what it was worth. So it's a negative thing for the business. They have to pay for more than what the people invested for. Okay, I know this can be very confusing, but just bear with me. So now at the end of the year, you're going to have an amount of shares. It's going to be your beginning amount plus the number of shares that were additional minus the number of repurchased shares, and that is going to be the total at the end of the year. Then you can do your amounts that you have. So the amount of money for the balance at the beginning plus the amount for additional received minus the repurchased. Again, this repurchased was calculated at the average cost of the shares, and you'll get your end of year figure. You would then say your end of year figure divided by the number of shares at the end of the year to get your Rand per share amount the balance that we are sitting at the end of the year. Okay. Any questions from this section?
No. Good
No,
on the side.
not same here.
Okay, perfect. Then we're going to move on to our retained income. So the balance at the beginning would be the amount that is given in your information, just the amount of retained income from last year, that at the first day of the year, before anything's happened, this is the amount of money I have in retained income. Net profit, this figure you would get from your income statement. This is your net profit after tax, complete net profit after everything. And you would put that over here. This can be a loss. It can be net loss. Then it would be in brackets for negative. Okay, like I've said, the repurchase amount over here is the extra amount paid for my shares that I've bought. So it would be the extra R1.30 times by the number of shares that I repurchased, and that would be in there as a negative. Okay, then dividends. Dividends are basically little payments that the company makes to their shareholders to say it's kind of like it's not interest, but it's kind of like interest. You're kind of saying a thank you for investing in the business. This is your portion, a small portion for you of the profit. There's not always interim and final dividends, depending on how the business has performed. It's generally not the best idea to be issuing high dividends if you're making a loss. That could be a theory type question, just to note that. Okay, interim dividends are paid halfway through the year generally, and they'll say 0, something rand. So it's generally like a cents amount. So say now it's 60 cents per share. You would say 60 cents times by the number of shares at that point in time. Generally, it's helpful to go to here and see what was my number of shares at that point in time. The final is the same. It would be whatever they say is the dividend per share times by the number of shares to get your amounts here. You would total these to get your total dividends over here. Dividends is we are paying, so it's negative, so it would go into brackets. Then to get your balance at the end, you would say balance at the beginning plus net profit, or if it's a net loss, minus net loss, minus repurchase, minus dividends equals balance at the end. Okay. Any questions from retained income?
No.
No,
Good.
thank you.
This side.
Okay, so then if we move on to trade payables, if we're looking in our balance sheet, we've now got our share capital and our retained income, which we've done. This amount, these two amounts would be totaled and give you a total shareholders' equity. Then here with non-current liabilities, you'll have your loan. This is your non-current portion of your loan. There's no note for it. If you do have to use any calculations, but say now if you have the amount of the loan and they say 10,000 Rand is current portion, just show that you're saying your amount minus 10,000 Rand in brackets over here. Then you'll get your amount and total up here. Sometimes you can have more than one loan, and that's when you would have more things and then total them up. But generally in an exam or a test, you won't have that because it's basically free marks because you're getting marks for the same thing over and over. Okay, then current liabilities. These are liabilities that are going to be paid off within 1 year. Now with trade and other payables, they'll have a note for it in note 9. You can have multiple lines under current liabilities. So I generally have trade payables current portion of loan, and then if there's a bank overdraft, bank overdraft. In the exam, if there isn't enough space for you to put current portion of loan or put bank overdraft there, then it means that they want you to show them in your trade payables. There's no real problem with either or. You can put that into there. You don't have to. Just look at what they've given you space-wise. Okay. So if we look into trade payables, we'll have our creditors control account. That's just your balance for creditors control, plusing or minusing any relevant adjustments. Okay, then income received in advance. That's when we receive our rent income in advance, and they will once again, it's like your prepaid expenses and accrued income. It's going to be portioned out, so you're going to have to work out the amount that was received in advance. And it's a liability because we've received the income, but we haven't given the service yet. Okay. With accrued expenses, that is when we haven't yet paid our expenses. So it could be like your telephone account, you haven't paid for a month, and they might give you the amount, they might want you to calculate it. It's all based on the activity or the question. Okay, and then that amount would go into here. You would total up to current liabilities. Then you would total shareholders' equity, non-current liabilities, current liabilities, and get an amount for total equity and total liabilities. This amount should equal total assets. If it doesn't, do not freak out, it doesn't matter. A lot of the time, you could have just made 1 or 2 mistakes, and to try and figure out where those mistakes were in an exam, it's not worth it because you get method marks. So if you have extra time, which generally you don't, because the accounting exams are very, very time pressuring, then rather just leave it and save it for the end. As long as you've got numbers there and it works in the way that this plus this plus this equals that, you're going to get the marks for that amount and for that amount, rather than try to force it. Never try to force it. You'll get more marks for method marks. And then sometimes what they do is they don't give you enough information to go and total everything and get an amount. Sometimes they'll give you, say now you've done your assets and you get your total assets, and they haven't told you anything about your loan. Then what you'll have to do is you'll have to take your total assets amount and then write it in total equity and liabilities, because generally that's what it's supposed to be. And then that amount, you work backwards to get your other amounts or anything that you're missing. Okay, and once again, I wouldn't stress, I mean, for my one fixed deposit in my trial exams, I had a negative fixed deposit, which obviously doesn't happen. But then again, it was only 1 mark because one of my numbers was wrong, or I left something out. So then it's just 1 mark that you're losing. So it's not the end of the world. Okay. Any questions for the liabilities and any other questions in general for balance sheet?
In terms of the trade and other payables notes, right?
Yes.
You have all the payments for your workers. So your UIF.
Yes. Yeah.
Okay. So how does that work?
So your UIF and like medical aid and all those types of things.
Mm-hmm.
Those you would put those in your trade payables as liabilities, because you are owing, say now, okay, let's just say we're owing UIF. Because we have to pay them. So it is now a liability. The thing is, based on different activities, they do it differently. Sometimes you just have to know to just put UIF there and to just put pay as you earn there. It would be the fund amount. It wouldn't be your expense amount. So it would be the total. So you would add up all the amounts that I've kind of owed for UIF and subtract any amounts that I've paid. And that would be the amount in your trade other payables. But it's difficult to explain that exact thing because it can be different with different situations. A lot of the time, the only one that you would have to calculate would be your income tax, which is your SARS amount, and how much you're owing SARS for income tax. I think the UIF and the medical aid, that is more just if they're wanting you to put numbers, put them in there to know that it's a liability. I didn't have many, I don't remember having examples of where I had to go and calculate a whole bunch of UIF examples. But if you do find one and you want me to help you, you can always WhatsApp it to me and I can send you a voice note back explaining it.
Okay.
Okay.
Thank you.
No problem. Are there any other questions?
No.
No, not from our side.
Okay. Well, if that's all, let me just, I'm going to stop recording.